Hey everyone, this is Millionaire Mentality, your source for growing your financial IQ and building your wealth. This bear market is wreaking havoc in the markets and causing major disruption, particularly in the crypto industry. Largely unregulated centralized exchanges like Celsius lending out hundreds of millions of dollars to other largely unregulated entities without the proper collateral or risk management policy continues to send shockwaves and drive max fear and panic. For many investors and lenders, this market has been a very sobering experience after getting high from cheap and easy money throughout the last massive bull cycle. And just in the past week, two more large crypto exchanges found themselves in hot water as fallout from the collapse of the stablecoin UST and crypto hedge fund 3 Arrows Capital, as well as aggressive rate hikes and economic tightening from the Federal Reserve, are not done creating pressure on centralized lending platforms. Before we get into it, as always, go ahead and click that like button and subscribe to the channel if you're new here.
Do it. Do it.
In the prior video, I mentioned how the government won't be bailing out crypto exchanges at risk of bankruptcy, similar to the way they did during the Great Financial Crisis back in 2008. Throughout 2008 and 2009, the Treasury Department allocated hundreds of billions of dollars to hundreds of banks who needed to be rescued from taking on too much risk with their lending practices and having it come back to bite them. We're seeing something very similar happening in the crypto industry right now, only this time this man right here is coming to the rescue. Meet Sam Bankman-Fried, the founder and CEO of FTX, which was another centralized crypto exchange, and 30-year-old billionaire who doesn't want to own a yacht and instead rather give away 99% of his earnings to charity. And earlier in the week, he was quoted saying that he feels like he has a responsibility to step in and help the industry, even if it comes at a loss, to prevent the wildfire that has been spreading across the crypto industry. News recently went public regarding BlockFi's and Voyager's massive lending exposure to 3 Arrows Capital, who is now facing insolvency, putting both BlockFi and Voyager at risk of potential insolvency themselves. True to his word, Sam Bankman-Fried, through his companies FTX and Alameda Research, provided revolving lines of credit of $250 million to BlockFi and another $500 million to Voyager to help them both stay afloat throughout this bear market and crypto winter. The good news is they were both able to secure lines of credit. The bad news is they both needed a line of credit. Both platforms remain fully operational at this time, although Voyager did just lower their daily withdrawal limit for many from $25,000 to $10,000 to mitigate the risk of a Celsius-style bank run. This is good news in the sense that it allows BlockFi and Voyager to fight another day. However, they are both deep in a hole, both financially and reputationally, that they will need to climb out of, and that process won't happen overnight. It also remains to be seen whether or not Voyager will be able to recover any amount of the $650 million it had lent out to 3 Arrows Capital. Voyager has given 3 Arrows until June 27th to repay, otherwise they will be issuing the hedge fund a notice of default and initiate legal proceedings. I still believe there is a future for centralized exchanges in crypto and that trust can be regained. But without the proper risk management and regulation, these exchanges may have grown too big too quickly. And I'm no longer personally comfortable holding any crypto assets in the custody of any exchange, at least until these storm clouds clear and all the dust settles. I can stomach taking on a loss on an investment that goes south. However, I have a harder time with the present risk of losing control of my funds and not being able to withdraw them as I wish. When it comes to my money, I am loyal to my money first and not to any one CEO or company. Remember that risk management is a two-way street. You are more responsible than anyone in managing the risks posed to your money and being properly diversified across your investments. Long term, as regulation comes and exchanges learn tough lessons on risk management, it should become more secure to give up your keys to let someone else take custody of your crypto. In the short term, if you are holding crypto on an exchange that you cannot stomach losing, now might be a good time to consider transferring at least some of those assets to a self-custody wallet where you retain control of your own keys to your coins. It's also important to know whether or not your fiat US dollars are FDIC insured on the platform you are using. FDIC insurance helps protect your US dollars in a bankruptcy event, and both Voyager and Coinbase are examples of exchanges that insure those dollars. However, keep in mind that if withdrawals get frozen due to liquidity issues, as we have seen with Celsius and now CoinFlex as well, you won't be able to withdraw those dollars if and until an exchange is able to resume normal operations, or the proper legal bankruptcy proceedings play out, which could be a lengthy process. I remain hopeful that BlockFi, Voyager, and many others will continue building their platforms and rolling out products and services that generate revenue. But it does remain to be seen just how disruptive these liquidity issues are going to be to their planned product rollouts, such as debit cards or geographic expansion. For instance, Voyager should be releasing their debit cards to the masses by the end of this month, which helps put crypto back into the pockets of those who swipe the card and are members of their loyalty program, as well as puts revenue back into the pocket of Voyager for every card swipe. But a lot of resources at exchanges are being diverted at the moment to address legal, compliance, and public relations matters. And we're also starting to see mass layoffs. Gemini is cutting around 10% of its entire 1,000 person workforce. Crypto.com is cutting 5% of its staff, or around 260 people. BlockFi is cutting 20% of its entire 850 person workforce. And Coinbase is laying off about 18% of its 1,100 person workforce. Despite BlockFi just announcing that they are increasing the rates on their rewards for Bitcoin, Ethereum, and stablecoins, I won't be surprised if we start to see rewards rates being cut over the next few months at most exchanges to help alleviate liquidity issues. In more positive news for exchanges, Binance US just dropped their fees for Bitcoin trading, which may create a fee war and put pressure on other exchanges to drop or lower their fees as well. This is essentially what happened in the world of stocks when Robinhood introduced their commission-free trading platform. Other major stock trading platforms like Fidelity subsequently cut their trading fees and expense ratios to compete. And if you were recently laid off from your job in crypto or looking to break into the industry, Binance also announced last week that they are adding 2,000 new job openings at the same time that many other crypto exchanges were announcing their layoffs. We're in what appears to be the early innings of Fed rate hike cycles and economic tightening, which has shifted investors into a risk-off mode as they are able to increasingly get more yield with safer assets like bonds and cash. The Fed continues to state that they are committed to bringing inflation back down to their target range of 2%. And until we start to see inflation cooling off, we may not see a complete appetite shift for riskier assets again and see big money flow back into stocks and crypto at a quick pace. For many newer investors, this might be your first bear market, and it's certainly a nasty one. There are so many lessons to be learned in both bull and bear markets. Never stop learning and growing throughout your investing journey and become a more seasoned and experienced investor in the process. Stay hungry, and I'll catch you guys in the next video.